The likelihood between the two cycles was that the transaction volume was very, very similar. That's for sure. We're facing about 1 billion of transaction volume a week these days, and it was slightly higher in 2007. The big difference which we're seeing at the moment is that it's in a much more stable environment. So where we're looking at is what's the level of equity which is being invested these days in comparison to 2007. And there we do see a big difference. We can see that the investors are actually putting money on the table to invest into property. In the old days, in 2007, we actually saw transactions, and I mentioned that today, we saw transactions where in excess of 1 billion, we actually saw the investors not putting a penny on the table. It was all debt driven. So that's obviously a different environment. So this is the one which we can see. The one which we also find interesting today is that the leasing markets are not detached from the investment markets. So we're seeing that leasing levels are picking up. So their fundamentals are good. The LTVs, the banks, the debt is there, but it hasn't gone up the risk curve as much as it used to go in 2007. So unfortunately, what we also have to say, what we see is that we can't sell every property because investors and banks will not buy everything. So some sales do stall, and that's completely different to what we saw in 2007. Virtually everything sold. These days, things do sell at a high price agreeably, but there's equity based on that. And if the property doesn't fit, the banks won't lend and the investors won't buy. That's probably the biggest difference.